This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
This is a lecture on Chapter 5 of the Paper F5 course notes on throughput accounting. Now, in fact, throughput accounting is an extension of something that you should have covered in Paper F2, or at university if you were exempt, something called key factor analysis. And so what we're going to have to do is, first of all, we'll revise quickly key factor analysis, and then I'll explain how throughput accounting builds on this, how it changes it, and we'll look at throughput accounting proper. And in fact, if it is asked in the exam, in all probability, the first section of the numbers will be asking you to do key factor analysis, and then in the second part you'll probably be asked to take the same example but to apply throughput accounting to it. And so before we get into throughput accounting, let me explain, or let me revise with you, key factor analysis. And the way I'll do it, we'll look at an example together and we'll use that to see what the problem is and how we approach it. So if you look at example 1 on page 15 of the notes, let's have a quick read together and see what the problem is, and then we'll go through the solution. So example 1, it says Pi manufactures two products, A and B. And below you're given cost card details for each product. So product A, for example, the selling price is $25 per unit. The costs, materials, labour, variable, fixed, the costs are $23 a unit. And so each unit of A is generating a profit of $2. You've also got the details for product B. The selling price is different, the costs are different, but as it happens, it's giving the same profit of $2 a unit. That's just a coincidence, but even so, both products are profitable. We know how many hours each product takes. A takes 2 hours to produce, B takes 1 hour. And we know what the maximum demand for each is. The maximum demand for A is 20,000 units, and for B is 10,000. Now, ultimately, our job is to decide how many of each product we're going to produce. And of course, if there was nothing else in the question, surely we'd produce as many as we expect to sell. Both products are profitable. So the ideal would be to produce 20,000 units of A and 10,000 units of B. There's surely no point in producing more of either of them if we're not going to sell them. However, there is one extra problem. If you look at the last line of the question, the total hours available are only 48,000. And it doesn't take too long to realize that with only 48,000 hours available, we're not capable of producing each product in full. You see, to produce the number we could sell, to produce the demand, for A, we'd want to produce 20,000 units at 2 hours a unit. That would take 40,000 hours. Additionally, product B, we want to produce 10,000 units, because that's what we can sell. Each one takes 1 hour to produce. That would take 10,000 hours. So in total, we'd need 40,000 hours. But of course, we've only got 48,000 available. And so again, we're not capable of producing A and B in full. And our job is to decide how many should we produce of each. Obviously, to only be using 48,000 hours, but at the same time, how many of each to give us the maximum overall profit. Now, there are several ways you could arrive at the same answer, but very standardly, with key factor analysis, there's a standard approach we take. It wouldn't really matter, but the standard approach we'll take, which will give us the optimum, the best production levels. And what we do first of all is for each product, we work out what the contribution is per unit. Now, contribution is a term that we haven't mentioned so far in paper F5, but it's a term you should be familiar with from paper F2. And in fact, is desperately important because the term appears many times in later chapters. And so forgive me if you already remember and it's obvious, but what we mean by the contribution, it can be expressed in two ways, to be honest. They both mean the same. It's either the selling price less all the variable costs, or, I say or, but what I'm about to write means exactly the same thing. The other way of getting the same figure, it's the profit before any fixed costs. Now, the reason we're going to look at the contribution is that product A, for example, although there are fixed costs there of $3 a unit, that $3 surely will have absorbed the fixed overheads. If you need to, look back at what we did in the activity-based costing chapter. But we assume that the total fixed overheads, I don't know what they are, maybe that in total it's 10,000, maybe in total it's 50,000. But we assume that in total the fixed overheads won't change, however many we actually produce. So whether I produce 1 unit of A or whether I produce 1,000,000 units of A, in total the fixed overheads will stay the same. But of course what will change as you produce more or less units, what will change are all the variable costs, the materials, the labor, the other variable, and of course the selling price. So again, the total fixed overheads will stay the same whatever. It's the selling price and the variable costs, which in total will change depending how many units there are. And so since that's what's going to change, and we are going to be looking at different levels of production, we know we can't produce 20,000 and 10,000. Well, because production is going to change, it's the contribution that we're going to look at. So again, what's the contribution per unit from each of them? From product A, check what I meant before, that you can get it two different ways. Either take the selling price of 25 and deduct the variable costs of 8, of 5, and of 7. And that'll give us how much? 25 less 20, it'll give us $5. Or alternatively, a quicker way of getting the same figure here, the profit before fixed overheads. The profit on the cost cards is $2. Add back the fixed overheads of 3, and again, $5. So whichever way you look at it, fixed overheads in total stay fixed, but each unit of A will generate $5. And similarly B, selling price less variable, 28 less 20, 2, and 2 is what? $4 a unit? Or take the profit of 2 and add back the fixed costs of 2, again $4. So that's the contribution we'll generate from each. And of course, A is the more profitable of the two. But given our problem is the limit on the hours available, the way we'll choose between the two is we'll look and see how much profit will we generate for each hour that we worked. And so what we do is we say how many hours does each unit take. So the machine hours per unit, straight from the question, A takes 2 hours, B takes 1 hour. And so again, see the logic, that even though A on its own is more profitable per unit, $5 against 4, if it takes 2 hours to make, well, 2 hours, instead of making just 1 A and getting $5, we could have made 2 Bs. And 2 Bs at $4 each would give us $8. So in fact, B would be the better use of the time. That may be obvious, but the standard way of looking at it is to work out the contribution per machine hour. A, it gives us $5 for 2 hours, which is $2.50 per hour. B, it's $4 for 1 hour's work, which is $4 per hour. And therefore, B is the better of the two, the better use of time. A is second best. Here we've only two products. In principle, there could be any number of products, but we'd choose between them based on the profitability, the contribution per machine hour. And now we can decide how many we're going to produce of each. Remember, we've only 48,000 hours available. The best use of time is product B at $4 an hour, so we'll go for product B first and produce as many units as we possibly can. However, do remember that since the maximum demand for B is only 10,000 units, there's no point in producing more than 10,000, we won't sell them. But we've plenty of time, and so we will produce 10,000 Bs. How many hours are we taking up? Well, each one takes 1 hour. And so that's used up 10,000 hours. We've still got plenty of hours left. Remember, there are 48,000 in total. We can't produce any more Bs. As I said, we won't sell them. And so the remaining hours will go to the next best. We'll go to B and produce A and produce as many A's as we can. So how many hours are left? There's 48,000 in total. The balance remaining, therefore, is 38,000. We're going to use that to produce product A. Well, each A takes 2 hours. And so, working backwards, with 38,000 hours, 2 hours a unit, we're capable of producing 19,000 of A. And so that's what we're going to produce. We said from the start we could sell 20,000 A's, but because of the limit on time, we're going to produce 19,000 A's and 10,000 B's. Now check the question carefully. If all this said is what's the best production, there's your answer and we've finished. Here, though, it does say calculate the optimum production plan, which we've done, but also what's the maximum profit that we'll generate. And so, to finish it, we know how many we're producing. Let's work out how much profit we'd get. Well, first of all, the contribution, that's no problem. A, we're making 19,000 units. And we worked out earlier that the contribution per unit, each A generates $5. And so in total, how much is that? 95,000. In addition, we're producing 10,000 Bs. Each B generates a contribution of $4, giving us another 40. So a total contribution of 135,000. And try any combination you like, but that's the maximum contribution we can possibly generate, given there are only 48,000 hours, machine hours, available. However, although that's the total contribution, the profit, we need to deduct the fixed costs. And I said right at the beginning that we've ignored them until now because however they've been absorbed, we assume that the total fixed costs of the business will stay unchanged. Again, if the total fixed costs were, for example, 60,000, it'll be 60,000 whatever happens. The profit will be 60,000 less. But if it's fixed at 60, maximum contribution will automatically result in maximum profit. The question is, though, what are the total fixed costs? Now, check the question carefully. What's very likely is that it'll tell you the total fixed costs. And we don't here, I appreciate, but if the question had said total fixed costs are 60,000, then simply deduct 60,000 and you've finished. However, it's just possible that, like this question, we're not told what the total fixed costs are. Now, if you're not told, we make one big assumption. We assume, now I will write this down in a moment, but we assume that when we did the original cost cards, we didn't know that there was going to be a limit on hours. And of course, if you didn't know the hours were limited, how many would you have budgeted on producing? You'd have budgeted on producing 20,000 A's and 10,000 B's. And so we assume that the original costings were based on budgeted production. And so, it's a big assumption, but even so, we assume that the cost cards were prepared based on producing to meet maximum demand. Now do think about that and pause this recording if you need to. It's awful just to learn a rule without seeing the logic. But again, you see, if we didn't know these hours are limited, then how many would you have expected to produce? You'd have been expecting to produce 20,000 A's and 10,000 B's. And how would you absorb the overheads? For product A, every unit, we'd been absorbing $3 fixed overheads, a total of 60. B, every unit we'd absorbed from the cost card a total of $2 fixed overheads, a total of 20. And therefore, we'd absorbed a total of 80,000 in fixed overheads. Now I'm repeating for the third or fourth time. Of course, we end up not producing 20,000 A's and 10,000 B's. But even though the actual production is lower, the total fixed overheads, by definition, we assume remain unchanged, that the fixed overheads will stay at 80,000, however many we ended up producing. And so on that basis, all right, we'd worked out contribution based on what we produced. Fixed overheads, we're saying, will stay at 80,000 whatever happens. And that leaves us, therefore, with a profit of 55,000. And again, since we'd worked out the maximum possible contribution, that 55 is the maximum profit. And there we are. We'd worked out optimal production, 19A, 10B. And the maximum profit we'll generate is 55,000. Now, I must stress one thing I said before. It is, if this is asked in the exam, it is very likely that you'll be told what the total fixed overheads are. And if you're told what the fixed overheads are, then this bit becomes irrelevant. If he says fixed overheads are 60, they are 60, and you stick 60,000 in. What I've done there is only relevant. That assumption I made, it's only relevant if he doesn't tell you the total fixed overheads. So do check the question carefully. However, that's key factor analysis. It should have just been revision, quite honestly, but whether it was or it wasn't, I hope that's clear. Again, although we're about to come to throughput, very likely indeed is that the first part of the question is conventional key factor analysis. However, now let me explain where the difference comes with throughput accounting. If you think back to what we've just done and the explanation I talked through as we were doing it, we knew with only 48,000 hours, production was going to have to be reduced. And we looked at contribution because we said if we produce fewer and sell fewer, we get less revenue. And equally, we say if we sell less and produce less, the variable costs will be lower. Materials, it's $8 a unit. In total, more units, more materials, less units, less materials, and similarly labor, and similarly other variable costs. Now that's a fairly standard assumption all the way through management accounting, but think about it in real life. And obviously I don't know where you work, but I think you'd agree with me, in most businesses, certainly in the long term, if production falls, you'll get the company will get rid of staff and labor costs will fall. But in the very short term, week by week, obviously most businesses, week by week, some weeks you've more business, you've more production, some weeks you've less production. But most businesses, in the short term, will tend to have a fixed number of staff. I'm not saying all businesses. Obviously, some businesses hire people as they need them. But most businesses, in the short term, the number of staff and therefore the labour cost will be fixed. It doesn't, just because one week you produce more, or the next week you produce less, in most businesses, the number of staff, the cost of labour, won't be going up and down. I say in the long term, definitely. There's no business which in the long term, with more or less business, won't have more or less staff. But the big assumption we make with throughput accounting we assume that in the short term, of the reasons I said, we assume in the short term that the cost of labour is actually a fixed cost. And in fact, for similar reasons, all costs in the short term are fixed, except, of course, for materials. Though with materials, clearly, if this week you produce fewer units, you'll buy less materials. If next week more units, you'll buy more materials. That materials certainly will be variable. But we assume, I keep repeating, but importantly, in the short term, we assume all other costs are fixed. And so we assume that in the short term, the only variable cost is materials. All other costs, labour, etc., are fixed. Now, I'm not going to repeat everything I just said, the sort of logic behind it, except to say there's no way I would say that's true for every company. But if you've understood me, I think you'd agree that certainly for a large number of companies, that is true. And that is fundamental. It's really all you need to know for the arithmetic that follows. And, of course, any written bits that go with the question. A fundamental point about throughput, or the fundamental point, is that assumption there, that the only variable cost is materials. And having made that assumption, the approach to our decision is exactly the same as we've just been using in key factor analysis. And so can you jump straight to example 2 on page 17? Ignore page 16 for the moment. I'll explain what's on there as we go through our example. But in example 2 on page 17, you've got exactly the same question that we had before. Pi manufactures 2 products. You've got the cost cards. Check back by all means, but it's exactly the same as before. And again, we're going to decide on the optimum production plan and the maximum profit. But this time, we're going to make the throughput assumption. So we'll take exactly the same approach as before. But remember, the only variable cost is materials. So let's do it. What did we do before? The first thing we looked at is the contribution per unit. Well, on our assumption, of course, this now changes. It's a selling price less any variable cost. But if the only variable cost is materials, if everything else is a fixed cost, then for product A, its selling price of 25, the variable cost materials is 8, it's 17 a unit. Whereas for product B, selling price 28, materials, the variable cost 20, it's $8 a unit. So, just like before, but just with this one assumption. Although, one bit of terminology is minor. More importantly, obviously, is the arithmetic. To avoid any confusion, the word contribution usually means what we did in example 1. Instead of calling it the contribution per unit, we call it the return per unit. So a minor point. Oh dear, sorry, I'm trying to change colour. Here we are. However, there effectively is the contribution per unit. But then, because of limited hours, we said, well, how many machine hours per unit? Again, from the question, A is 2 hours, B is 1 hour. And to choose between them, we looked at the contribution per machine hour. Well, A, $17 from 2 machine hours is $8.50 per hour. Product B, $8 from 1 hour is $8. And although the decision won't always be different, for this example, the best use of hours, surely, is A. Every hour used on A generates $8.50. On B, it generates only $8. One more bit of terminology before we finish it off. Just as I said, instead of calling it contribution and risk confusion, we call it return per unit. Well, similarly, the contribution per machine hour, we change its name. We call it the return per factory hour. So again, that's only terminology. In all other respects, the logic, the arithmetic, is just like before. So let's carry on just as we did before and work out what is our optimal production plan and what's the maximum profit. First of all, the production. This time, A is the best, so produce as many A's as we can. Again, we won't produce more than we can sell, so we'll produce maximum demand, which is 20,000, and that'll use up 2 hours a unit, 40,000 hours. We've still got hours left. We're 48,000 in total. The balance is 8,000. We can't make any more A's, we won't sell them, so we'll use the remaining hours making the second best product B. Each B takes 1 hour, And so with 8,000 hours, we're able to make 8,000 units. And so there is our optimal production plan. That's the production plan that will generate maximum profit. Assuming, as almost certainly be the case, that they want you to carry on and work out the maximum profit. Let's do it. First of all, the return will generate. Contribution, but return we call it. No problem. We're making 20,000 A's. And if you look back, each A generated $17. In addition, we're making, 8,000 B's. And each B gave us a return, a contribution of $8. A total of 404. And again, that's the maximum. With only 48,000 hours available, that's the maximum we can possibly generate. However, again, like example 1, we need to get the profit, we need to deduct the total fixed cost. And again, as I kept stressing in example 1, check the question carefully. If the examiner tells you the total fixed costs, simply use that figure and deduct it. If not, make the same assumption as before. And here, because we're not told a total, we'll assume that our cost cards were based on producing to meet full demand, that we didn't know that the hours are limited. And so how many did we think we'd produce? If there was no limit on hours, it would have been 20,000 A's and 10,000 B's. And how much fixed cost per unit did we arrived at? Well, remember that this time we're assuming all the costs are fixed except materials. So this time, the fixed costs for A from the cost card, there's labour 5, other variable 7, fixed 3. We're assuming the total labour, variable, fixed, that the total is in fact a fixed cost. And so the total comes to what? It's 5, 12, it's 15 a unit. 20,000 at 15 is 300,000. And whether we produce more or less, we assume that total stays the same. Similarly for B, the fixed costs under a throughput assumption are labour, other variable, and ordinary fixed. A total of 6. 60,000, 360. And although with different levels of production, the return would change, the fixed costs stay the same, and as a result our maximum profit this time is 44,000. And although it's not really a question of comparing example 2 and example 1, in fact, if you do look back, on this example with a throughput assumption, we've ended up with the maximum profit being lower. And if you think about it, I'm not really surprised, because we knew we were going to have to produce less than we originally budgeted. In example 1 with key factor, producing less meant we were assuming less material, less labour, less variable. However, under throughput, producing less, it's only the materials cost that reduces. We don't save anything on labour and other variable through lower production. And so because we save less, we've ended up with a lower maximum profit. So there is the throughput approach. However, before we leave it, you'll see part B of the question asks you to calculate what we call the throughput accounting ratios. And you could be asked for this in the exam. And so let me explain what the throughput accounting ratio is. The numbers, as you'll see, are easy, but let me explain what it is and then the relevance of it. So with the same example, first of all, and it's printed on the previous page, but the throughput accounting ratio is defined as being the return per factory hour divided by the cost per factory hour. Now, see, I'll explain the relevance afterwards. Just let's do the arithmetic first. But the return per factory hour divided by the cost per factory hour. Now, the return per factory hour, we've worked out above. If you look back, we looked at the return, effectively contribution, divided by the machine hours. We'd got a return per factory hour. Every hour used for A was $8.50. Every hour for B was $8. So we know what that is. However, to complete the ratio, we also need to know the cost per factory hour. The cost per factory hour is defined as being the total fixed costs divided by the limited hours. And so check with me what it is here. First of all, what are the total fixed costs? Well, remember, we are doing throughput, and so everything apart from materials is fixed. And I said, although you may be given the figure, here we calculated the figure. The total fixed costs were $360,000. So there's your total fixed costs. We divide that by the limited hours. Well, the hours available, the limited hours in this question were 48,000. And so, costs of $360,000 divided by 48,000 hours. Check me, but I get $7.50 per hour. Well, we know the cost per factory hour. Earlier we'd worked out the return per factory hour. So now we can calculate the throughput accounting ratio. We do it for each product separately. First of all, for A, the return per factory hour was how much? $8.50. Divide by the cost per factory hour of $7.50, and that gives us 1.13. There's no units to it, it's just a ratio, 1.13. And similarly, B. I won't wind back, you can check yourself, but I think for B, the return per factory hour was $8. Again, the cost per factory hour is $7.50. And so 8 divided by 7.5 is 1.07. Now, for the moment, that obviously was just an arithmetic exercise, but you could be asked it. And so learn what we mean by each of those, learn what the throughput accounting ratio is, cost per factory hour, return per factory hour, but otherwise, I think you'd agree, easy arithmetic. Equally, though, if the examiner does ask you to calculate it, then almost certainly you'll also be asked to write a few lines explaining the relevance of the throughput accounting ratio. And there are two things here. The first, I think, is very obvious. If you need to, again, pause and think about it. But the first point is surely the higher the throughput accounting ratio, the better the product. Now, I appreciate we didn't need to do that calculation to know that. We already knew that A was best, B was second best, because of the return per factory hour. But automatically, looking at the throughput accounting ratios, A is the highest, that was the better of the two. B was the next highest. Well, we produce A first, any hours left over we produce B, and if there were more products, we'd carry on down the line. The second bit, though, well, you tell me. You can't tell me, but think for yourself. What ideally would make a good product? What I mean is, ideally, what would you want the throughput accounting ratio to be for products to be good products, to be worth producing? Surely you'd want the throughput accounting ratio to be more than 1. Our production, every hour worked is costing us $7.50 in fixed costs. Surely ideally you'd want all the products you made to be generating more than $7.50. And as a result, you'd want the throughput accounting ratio to be more than 1. So you'd want to aim to achieve a throughput accounting ratio of more than 1 for all products. We know we're not capable of making A alone the best one. We're going to have to make some B, and if there were more products, maybe we'd have to make some C, and so on. But ideally, you'd be trying to achieve that all your products were giving a ratio of more than 1. Now, I'd better mention, although don't worry too much, but it will have occurred to some of you. Although that's what you'd want to try and achieve, and if any product was giving less than 1, you'd be looking to see if you could increase selling price or reduce materials costs. However, just because the throughput accounting ratio was less than 1 wouldn't mean you'd automatically reject that product. Because remember, you're incurring your fixed overheads anyway. Well, any contribution towards them would be worthwhile. However, that's of lesser significance. The important thing is, I hope for reasonably obvious reasons, certainly you'd be trying to get more than 1 on every product. All right, well, that's really it. However, just 2 more things which won't affect the arithmetic at all, but just in case they're mentioned in the exam. The first is, in our example, which is a very simple one, but to be honest, if it's in the exam, it's unlikely to be any more difficult. In our example, the whole problem was we had only a limited number of hours available. In real life, it's very likely you'll get that situation. There will be limits on production. But what is likely is this, that maybe the products you're producing go through various processes, or there are various machines involved. Maybe we're producing A and B. Maybe, first of all, they worked on machine 1. And then when machine 1, when the work's finished, they move on and they go to machine 2, and they go to machine 3, and so on. There could be various machines involved. And what's likely to happen in real life is where there are limits on us, that it's one of the machines that's causing the problem. Perhaps, for instance, machines 1 and 2 have effectively unlimited capacity. Which I can't spell, but still, unlimited capacity. But machine 2 is the one that's slowing us down. Perhaps machine 2 has limited hours. Well, when you do have that situation, which I think you'd agree in real life is reasonably likely, whatever's causing the problem, machines 1 and 2, unlimited is unrealistic, but perhaps they can produce far more, but it's machine 2 that's blocking us, that's slowing us down. We call it a bottleneck resource. So it is less likely to be mentioned, to be quite honest, but if there's any mention of a bottleneck resource or a bottleneck machine, that's the one that's causing us problems. That's the one that's slowing us down. That's the one where we've got limited hours. It's called a bottleneck because if you think about pouring liquid out of normal bottles, a beer bottle or something, surely the top of the bottle tends to be smaller, and it's the fact the top's smaller that stops the liquid coming out any faster. Bottleneck. However, that's all the bottleneck is. And in terms of the arithmetic, which I say it's very unlikely to be relevant, but nothing would change from what we've done before, except that it's only this bottleneck machine where you'd be looking at the hours. The final thing to mention, but certainly again only for any written part, it will not affect your numbers at all, is that I said at the very beginning of throughput that in the short term, labour, another variable, are likely to be fixed costs. Now, I've said enough about that. I'm not going to repeat. Look back yourself if you need. But I said materials certainly are going to be variable, in that if you produce less this week, you'll need to buy less material. If you produce more this week, you'll need to buy more material. Well, of course, that is true, provided we're not keeping big inventory levels. Because, of course, what you could do is you could say, well, on average, we produce 10,000 units a month. You could buy the same quantity of materials each month. And months where you used less, you'd be building up inventory. And then months where you produce more, you'd be using it from inventory. And in a sense, that would start to make materials a fixed cost as well. And so throughput makes one other assumption. I've already said, but I will write again, it assumes that all costs are fixed except materials. The second assumption is that for materials to be truly variable, it does assume that we've got low inventory levels. In a perfect world, zero inventory. Or, of course, that we're using just-in-time philosophy or approach. Now, if you've not already looked at the earlier chapter or listened to the lecture on just-in-time, do. But you should be aware just-in-time does assume that we manage to achieve very low inventory levels. And on that basis, materials are going to be variable. And it's part of the whole throughput assumption. Well, that's everything to do with throughput. So, have a read through and make sure you're happy with, and obviously practice it.